Welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and as you know, we are dealing with the markets. We're dealing with the markets. Wait a second, Justin, what are you talking about? Yeah, for the last little bit, I have spent a lot of time talking about business, and we've had a lot of people on the show to go over business. We've dealt with the 7A loans. We've dealt with the 7B loans. We've dealt with how do you work remotely. We've dealt with a number of things, but at my core, I love opportunity. I love opportunity. I love the fact that we can see something and seize the moment. I think it was a carpe diem. I think it's the word. I probably just butchered my Latin word. I think it means seize the moment. Some of you who are out there in the internet world, I pulled that straight off my memory. Tell me if I'm right. Hit me at Justin Goodbread on Twitter. Hit me at Facebook, LinkedIn, Google, whatever you want to find me at. And tell me if I'm right on that. Seize the moment. I think or seize the day. Carpe diem. I may be wrong on that. But anyways, so look, I brought on the show today, one of my colleagues, Mr. Chris Stewart. Let me tell you, this guy's a rock star. For those of you who've joined the podcast recently, you've heard him talk. For those of you who've watched us on YouTube, you've seen his pearls of wisdom shine through. For those of you in the podcasting world, and those of you who are going to watch this video on YouTube, I want to formally introduce you to my colleague, Mr. Chris Stewart. Let me tell you, he is a wizard. This guy is like stupid smart. I mean, it's crazy how smart he is, especially in this area that we want to cover today. So Chris, man, without introduction, man, glad to have you on the podcast today.
It's great to be here.
So Chris, I got to ask you, what is a CFA?
CFA stands for Chartered Financial Analyst. It's one of those credentials that most people on the mutual fund side, on the investment banking side, like to get. And believe me, it is a very difficult thing to do. It almost caused my divorce.
So, I've taken the CFP. I've earned the Certified Financial Planner course, and it's the gold standard in the world of financial planning, right? So if I were to liken the CFA, the Chartered Financial Analyst, to the Certified Financial Planner, could I say that the CFA is the gold standard in asset management, so to speak, on Wall Street?
I would say yes, absolutely.
Okay.
And I'm in a unique position having done both.
Yeah, see, I told you folks, he's like wicked smart. I mean, this guy's a walking brain. So Chris, tell me a little bit about your background, brother. How did you come to be the all-knowing Chris Stewart?
Well, if I'm all-knowing, it's only having been through the school of hard knocks. No, I started out my career after grad school at the New York Fed, and was there through some really interesting times, including the 1987 market, including the Drexel Burnham Lambert bankruptcy. There were a lot of things going on. It was a very interesting viewpoint from the markets. And having moved down from there to the buy side, working for Scudder Stevenson Clark, I had the opportunity to use my academic bent, do some research on the global bond market, and that turned into a reading that was used for the CFA program on the global bond management. So from there on, I love doing white papers, really getting into an academic topic and tearing it apart.
So you've actually written some of the credentialing, worked with the team to write some of the credentialing for the CFA program. So you're like the teacher of the, well, I know you're not teaching it, but you could technically be a teacher of the program. Is that correct?
Exactly. It's been so many years, I passed it on to somebody else who is much more current with the markets. But for many years, that was part of the curriculum that was used for level 3, the highest level.
So Chris, you've been around a little while through this markets. I can remember 2007, 8, 9, but man, you go back even through 2001. Were you in the markets during the 87?
Absolutely. That's at the New York Fed. We watched it all happen from there.
So interesting point of view. I don't know if you knew this, Chris. I wrote an article, I think it was for Kiplinger or Forbes, some 2-3 years ago, comparing what happened if somebody took $100,000 and dropped it in on that Friday, arguably the worst day to place the money in the market, and then comparatively placed it on Monday, the following day after the crash, which arguably the best day to invest in the market, and ran that out over like 15, 20, 30 years just for an illustration. And it was amazing that the market volatility did not affect the long-term portfolio value once you got past 5 to 7 years. I always thought that was intriguing, and I had to do my own study on that. So, your perspective then, as we go through today's conversation, is not just the recent history of 7, 8, and 9, not just one, but you've been through a couple of these market corrections now during your career. Is that fair?
Very fair.
So
the last one.
He's like, I'm done, folks. This is it. I'm putting it all up. No, we know better than that, buddy. You're going to be around a little while longer as we go through these things. And, maybe it won't be anything as crazy as what we're dealing with. But speaking of which, I've heard a lot of people, Chris, say, this is a lot like 2008, 2009. And brother, I just don't see that being the case. What are your thoughts?
Well, first of all, there's an old joke in the markets. The scariest thing to hear is it's different this time. But it really is. The big difference between this and 2008, there are two. First is that the economy is slowing down because we're shutting it down purposefully to slow the spread of the virus. It's not that the buyers are going away and people aren't investing. The second is that 2007, 2008, every weekend we go away and we come back and saying, please God, don't let there be a big bankruptcy. You had Lehman Brothers go bankrupt. You had AIG really in dire straits. You had a lot of banks that were, quite frankly, it could have failed. And we got through that. Right now, the banks, the financial system, the financial stocks have taken a hit, but we're not worried about bankruptcies. We really, after the 2007-8 crisis, went back, changed the capital rules. They're solid. We're not going to see bankruptcies there. So those are the two big reasons why it really is different, this downturn.
So, Chris, one of the things I was noticing in my own world, and my numbers are not going to be probably as pristine as yours. I'm generalizing some numbers here. But whenever I was looking back through this year, January came like right out of the gates, shooting off a block like a runner would. And I think we were up like 5% on a couple of the major indexes. And I'm sitting here going, holy cow, if this thing continues, we're going to be up 40% in the market. Then we get our early February numbers and they're showing, hey, GDP is increasing like at 3.2% annualized. I'm like, this is crazy. And in my world, in your world, as we're working with clients, one of the things we started saying is, hey, just be, whenever, I love Warren Buffett's quote when he says, when people are greedy, be fearful, and people are fearful, be greedy. And I can remember saying, let's rebalance, but let's hold tight. Then all of a sudden, 12 trading days, holy cow, like the bottom fell out. Then the brakes came on. Then we fell some more and we've recovered. Did I kind of reassess our year thus far?
Yeah, I think you hit the nail on the head.
So one of the things that I'm hearing is, Chris, can it get worse?
Well, I don't have a crystal ball. It could get worse. But again, this crisis is driven much more by what's happening with the pandemic than it is really what's happening with earnings in the market. Number one, nobody knows what the earnings are dependent on the economy reopening. If the economy does reopen, how quickly are people going to want to go to restaurants, get on airplanes? It's a big unknown. So yeah, it could get worse, but I'm hoping that it gets better. And just having more certainty about what the future looks like will be a good thing.
So, Chris, one of the things that I often teach clients, and I don't think I've ever done on the podcast, is the idea of a leading indicator versus a lagging indicator. And the way I'd use it, I'm going to put it in my financially simple mind, is a sense of an arrow. Now, I love to hunt. I love to shoot my bow. I'm just an old country boy. In fact, I was sitting in the woods watching turkeys and deer this last week. It was outstanding. Sun was up here in East Tennessee. It was probably 75 degrees, not a cloud in the sky. I just want you to be jealous of living up there in Boston right now. That's how beautiful it was down here, okay? But on my arrow, I have a tip on the arrow that will often penetrate the target. And then there's the long shaft, which is the stick part of the arrow. And then there's a fletching, which is like the feathers part of the arrow. And then there's a nock, which is what you attach to the string. Yeah. And whenever I talk about the leading indicator, I like the analogy of an arrow that tip hits the target many times before the fletching or the nock ever does. And oftentimes we are the market, being as a leading indicator, is the tip of the arrow, whereas we're living oftentimes back here in the fletching point, meaning that the market is attempting to price in the future today.
Yeah, absolutely.
How would you describe a leading indicator to try to make it maybe a little bit more technical than my simple arrow analogy?
Absolutely. So the arrow is a great analogy because you're trying to predict the future, and one little change in that future forecast can have a big swing at the fletching arrow, at the fletching part of the arrow. So lagging indicators are ones like employment.
Mm-hmm.
So the jobless rate goes up after the economy is already slowed. The leading indicator is something like investment. If you're a business owner, and we have a lot of business owners here, you're not going to make that investment that you expect to pay off over 5 years, 10 years, whatever, if you're not confident about the future. So that's a leading indicator.
So is that why, Chris, I'm not to interrupt you there, but I did, sorry. Is that why last week, I think it was, when we saw the jobless rate go up, I mean, it would just spike way up, 6.1 million or something like that the market's actually etched up a little bit that day? Because is that what I would anticipate? And we're teaching people here through the podcast, is the reason why it spiked up is because the jobless rate was not as bad as they anticipated. Is that a fair way to say that?
That's a very fair way to say that. The market's always trying to look well into the future rather than what's right in front of it. There's also an expression called buy the rumor, sell the news. So if you think the jobless claims are going to be one thing, you may buy into it. And if they are exactly that, you sell them because the market's already priced that in and they're looking at the next thing.
So right now, I heard the president say in a recent address, and then I heard several of the talking heads, which have been updating our world at this point, say, we could end up with a high death toll, like the next 2 to 3 weeks could be catastrophic. I heard someone say that our unemployment could reach 40 million people here in the near future. Could I anticipate, I know we can't, none of us can predict the future, but could I anticipate that the markets are hearing this news and they're already trying to price into those potential things which could happen in the next week, 2 weeks, 3 weeks, 4 weeks? Is that what a leading indicator is doing?
Yeah, I think that what we've seen, the market's up again today, was up the last 3 days. I think what you're already seeing is there's a hint that maybe the New York coronavirus curve is flattening, and that's good news. The market already priced in such a dire result that just a little bit of good news is beginning to lift it. I think that's a really good example of what we've seen over the last week in the markets.
As we're doing this teaching today, kind of going through a think tank session with you and I here for the listeners on the YouTube. And by the way, friends, if you're on a podcast, check out the YouTube channel. You get to see mine and Chris's beautiful face on YouTube. If you go to financiallysimple.com financiallysimple.com, no, go to YouTube /financiallysimple.com, and you'll find us there on YouTube. We will also share this on all of our social media channels, Twitter, Facebook, LinkedIn, etc. This particular beautiful picture of the dynamic duo here on this particular podcast. But that being said, Chris, when we're looking into trying to explain the technical terms, I've heard this idea of a bear market. And I've heard this, not idea, I've heard this reality of a bear market now. And I've had a lot of listeners send on to Ask Justin. So www.financiallysimple /Ask Justin. They've said, hey, what is a bear market and what is a bull market? So what's the definition of a bear and a definition of a bull market when it comes to investing?
Yep. So the rule of thumb is 20%. If the market goes down 20% from its high, that becomes a bear. If it recovers, it's a bull. What's interesting is right now we're pretty much 20% below the highs and 20% up from the bottom.
Wow.
Which is kind of crazy, but we're still significantly down.
So we've had technically then, I think I heard that we've had technically a bear market and a bull market. Yeah, we're still in a bear market. Is that what you're saying?
Right. And you do get rally. There are all sorts of terminology. You can have a bull rally, a bear market rally, a strong rally within an overall bear market. Typically, a bear or a bull is something that you expect to last for multiple years. It's within a very long-term trend. Now, of course, overall, the long-term trend of the market is up, regardless of some bear markets. Most bear markets don't last more than 4 years on average. And that's the recovery from the bottom, from the bear market moving forward.
So, Chris, one of the questions that I heard is, and I think it's a fear, and I want to deal with this concept of reduction to the ridiculous. Okay. That's a technical term that we've used in our industry a lot. And what I hear is, and I've had actually one individual, it wasn't a client, by the way, but one individual ask me a question. They said, "Hey, Justin, I understand that now, according to you, is one of the greatest times to invest in the market in your lifetime." And I said, "Yeah, I firmly believe that. And with all my power, I believe that as a business owner." But they said, "Yeah, but what if?" And I get these what ifs like, Justin, what if the coronavirus kills half our population and we don't have enough workers in the workforce? What if the stock market drops, the Dow drops from 2021, whatever the number is today, I don't know anymore, whatever the number is today, what if it drops down like 4,000? What if, the banks fail because of all this $2 trillion of printing money? And I've heard all these what ifs. And we use a term called reduction to the ridiculous. What does that mean?
Well, that's actually a Latin phrase. You're using 2 Latin phrases in one podcast.
Oh, wow. Cool.
Reductio ad absurdum. And what it means is that sometimes you have a theory that sounds good, but if you really follow it to its extreme, it becomes absurd. People during the tech bull market thought that these companies could grow. The expression then was, trees don't grow to the sky. You just don't have that kind of exponential growth that goes on forever. There are multiple examples of this in history. Malthus thought that, just based on growth rates that the human population would be starving within, 20, 30 years. Of course, didn't take into account technological growth and seeds, fertilizer, et cetera. So it's just a theory that taken to its extreme seems silly.
One of the things that I mentioned, I guess it was a couple of years ago, 2018, when the fourth quarter dropped, was like 18, 19%, depending on which index you want to look at on the equity markets. I had a lot of people say, "Oh my goodness, the big one's here again. We're going to have, 2007, 8, 9 is going to be crisis again." And I use the analogy because at that point in the almost winter time of 2018, we actually received a little bit of snow. Now, for us down here in the South, we're not in Boston. If we get snow on the ground, dude, it's like the whole world stops. I mean, run out, grab milk and bread, and go home, right? Yep. And so I made this analogy that, reduction to the ridiculous says that if I look out on my deck out my back window and I see a half inch of snow, I'm going to look at Emily and say, "Hey, grab the kids, grab the chickens, grab the goats. We're going to Cancun now, because if this thing doesn't stop, it's going to be like 40 foot high and we're all going to freeze to death. The polar bears are going to invade and the penguins are going to be here."
Right.
I know that's an absurd illustration, but does that, I wouldn't say accurately, but does it illustrate reduction to the ridiculous that many people have at this point?
I think the shortage of toilet paper is one example of the reduction to the ridiculous.
Yeah, guys, I got to tell you, whenever I jumped to this podcast, Chris had this face mask on. Now, he's in his house. He's safe distancing in his house. And he came on the screen. There's this face mask. Yeah, there he.
Don't worry, everything's fine.
So this is the clowns that I work with in the office here. Let me ask you one last question here, Chris, so we can wrap this thing up. I've made this statement, and you may not agree with me. That's fine. It's my prerogative. I know I'm right. You feel free to make my opinion yours, but anyways, I made this statement that I've said a couple of times now, that I believe that the economy right now, for those of us who's been sitting in cash, is one of the greatest buying opportunities in my lifetime. Now, maybe not in yours, but in my lifetime that I've seen. And I know a lot of our listeners on the podcast, on the YouTube channel are a younger generation, even younger than I am, and they're experiencing this burn of their investing for the first time. They didn't go through 07, 08, 09. They're going, oh my goodness, this is crazy. And I'm saying, what an opportunity. Warren Buffett made the statement, I think I said this earlier, or maybe I've said it sometime recently, that when people are fearful, be greedy. When people are greedy, be fearful. And, if I thought that XYZ stock was a good company back in January, then holy cow, barring that they're not in one of these major effective positions, and they should be a sell of a deal right now. Yep. So would you agree with my assertion? I'm not putting words in your mouth, that it is a great buying opportunity if you position yourself well at this point?
Yeah, I would say several things. One, if you're young, this is great. You're getting in at lower prices, bargain prices. But to any client, certainly make sure you have your emergency fund. Don't spend every dime you have in your savings account on the market. But also put it in the broader market. It's very hard to know who's going to be the winner, who's going to be the loser, what companies are going to come out of this much stronger. So my brother did this in his own account. He bought some individual stocks, and one of them I noticed went down 86% because it was under investigation for accounting fraud. And that's a big chunk of that account. So invest broadly, make sure you have an emergency account. And yes, absolutely, this is a great time to invest in. And the younger you are, the longer you have for everything to work out. And history shows that over the long term, stocks always do well.
Wait a second, Chris. I got to deal with something here. I was going to be done, but I have to deal with one last thing, okay? I have had no less than 30 young people say, Justin, which stock should I buy right now? Which company should I buy? Hey, look at Amazon. And I'm not recommending Amazon by no approach, guys, but look at Amazon. They're getting ready to hire 100,000. This was the news a couple of weeks ago. Maybe I should buy them. Wait a second, Chris. You have a CFP, you have a master's degree in economics, you have a CFA, which, friends, I don't even want to think about passing that test in the knowledge level. And I believe I just heard you say invest in a diversified, broad basket of equities versus one or two or three you're trying to pick some stocks. Did I hear you correct?
Absolutely. Absolutely. The core of your portfolio should always be well diversified. If you want to take a flyer on a couple of stocks, carve out a couple percentage points of your portfolio and do that. Have fun, but don't bet the farm on picking the best 3 or 4 stocks that are going to do well for the next 20, 30 years.
Chris, my last question, I promise, the last question for you. I've asked every podcast guest, and I've had a couple of them that I've asked the same question to twice. And it's just interesting to see where every person is in their position at that day. Yeah. So the question I'm going to have for you, if you have one chance, one pearl of wisdom to share, doesn't matter what it's about. I'm going to ask you, what would that be? So let me kind of lay out why you're thinking about that, because that's a very deep question. I want you to give some time to think about it. Friends, the reason why I've been asking that to the podcast guest and to the video guests we've had on the show is because everybody approaches life differently. It's kind of like looking at a car wreck. No one's going to see the exact same thing. And we all have different experiences and different backgrounds. It's been said we are the sum total of the choices that we've made in our lives. We're the sum total of those. So everything that we are today in our person is because of our experiences, which ultimately were our decisions that we made, the choices we made. So I love hearing wisdom, and I've been listening from all the different guests, Chris. It's a common thread, and it's been fun for me. And I don't know what you're going to answer is, but I'd like to know, Chris, now that I've given you some chance to think about this, what is that one point, that one pearl of wisdom that you have with your background as you sit today in your particular cozy chair there in Boston, Massachusetts, and you could spread this one message out to the listeners who are business owners and dads and moms and employers and lay people at churches and just citizens? What would that one pearl of wisdom be?
Certainly in regards to investing is make a plan and stick with the plan. Abraham Lincoln said, if I had 8 hours to cut down a tree, I'd spend 7 sharpening my axe. It really is that simple. We were talking about this before. I'm a pilot, When things are going well, but especially when they're not going well, I stick with the checklist. The checklist tells me what is going to get me safely to my destination in every situation. If something is going wrong with the plane, it's a really uncomfortable feeling. The market's going down, it's a really uncomfortable feeling. But stick with the plan, because the plan is based on history, is based on academic research, is based on how things function. And it's the best way that you're going to get to your destination safely.
Chris, thanks for joining me today, brother. I appreciate it, man. What's some interesting perspective, but also some wise perspective, brother. Thanks for joining me today on the podcast.
All right. It's been a pleasure.
Hey, we're going to have to do this again, folks. So look, I realize life is hard. I realize that life is good. Life can be frustrating. Money doesn't have to be. We're going to continue to make our lives at least financially simple. Before I sign off, let me give you one more piece of information. Stay tuned to the Justin Goodbread Facebook page, the LinkedIn page, the YouTube video, and the podcast. We're about ready to launch, very close to launching a complimentary retirement plan for you. For those of you who've gone through some problems, those of you who've dealt with this particular issue, and you're like, hey, man, what should we do in the marketplace? You've heard Chris, you've heard myself, you've heard some of the other leaders in our company. We are really close, finalizing the details on a complimentary retirement planning process that we're going to roll out to the listeners of the Financially Simple podcast, which are many. It's amazing to see how many downloads we're having at this point. So until then, friends, like I say every week, you got to go out and make it a great day.